Good afternoon, class. You are welcome to PLBC Virtual Classroom Simulation. I am Mubarak Shehu Musa from Hassan Usman Katsina Polytechnic. Today we are going to learn financial accounting for SS3 students. And in our previous classes, we've discussed what is a company, how companies issue shares. For today's lesson, we are going to learn the final account of a company. Like we discussed in our previous classes, companies are required to publish their financial statements. So it is very important for you to know how to prepare the final account of a company. And when we say the final account of a company, we mean the trading profit and loss account and the balance sheet. The trading profit and loss account will show us the profit or loss such company has made, and the balance sheet will show us the financial position of such business. When we say financial position, we mean the assets of such business, the liabilities, and likewise the shareholders' fund. Now, for the final account of a company, it is quite similar with the final account of a sole proprietorship and a partnership business, meaning the trading account is the same. Opening stock, add purchases, add carriage outwards, less return outwards, cost of goods available for sale, less closing stock, you arrive at your cost of goods sold, and finally you arrive at your gross profit. The expenses are likewise similar, meaning the profit and loss is similar. The only difference between the final account of a sole proprietorship or partnership business and the final account is additional of some expenses. So for example, let's assume this is your final account. You have your gross profit here. Let's make assumption. You have your gross profit here, and probably you have another income, discount received. And here we'll bring our expenses. Let's say we have discount allowed. And we have carriage outwards and wages. We're all familiar with this. And like I said, the only additional item in the final account of a company is we have three additional expenses. We have what we call director's remuneration. When we say director's remuneration, we mean the board of directors, people saddled with the responsibility to manage their company. What is their remuneration? We are required to disclose it. We are not required to add it to salaries or wages. No, you are required to disclose it differently. And likewise, we have what we call audit fees. Now, as a company, after you have finished preparing your financial statement, you are required to invite an independent auditor to come and make verification of the financial statement, to come and check whether you have prepared the financial statement based on the accounting rules and regulation. Now, after you have invited such independent auditor, you are going to pay him a remuneration. And this remuneration, we call it the audit fees. And finally, the other additional item we have is what we call debenture interest. The word debenture is similar, is a loan. But what kind of loan? It is a loan that companies buy from the stock exchange market. It is not a loan that you go to the bank and get. No, you cannot access a debenture from commercial banks. You can only access a debenture from the stock exchange market. It is a loan that has a long tenure of maybe 20 to 25 years or 30 years. Now, if any company has accessed a debenture, now such company will have to pay back the loan plus the interest, meaning we have to pay back the principal and the interest. Now you have to bring the interest here under the expenses side of the profit and loss account. So these are the only three additional items that are peculiar to the final account of a company. Now, by the time you add these items here, you are going to have the total expenses, And if you compare the total expenses with the income side, if the income is higher than the total expenses, we are going to have a net profit. So we could see, like I said, the only difference in the final account of a company with that of a sole proprietorship and a partnership business is only the additional of these three additional items: the director's remuneration, the audit fees you are going to pay your auditor, and the debenture interest you are going to pay for the debenture loan you have access. By the time you compute, you either end up with a net profit or a net loss. Now, this is the trading profit and loss account for a final account of a company. Now, apart from the trading profit and loss account, you are also required, after you have arrived at the net profit, you are required to appropriate the net profit. When we say appropriate, it means share the profit, the final profit, to the relevant stakeholders. So we have appropriation account, which is a continuation of the profit and loss account. Here we said we had the last item here was a net profit, BD. Now you are required to share this net profit to the relevant stakeholders. And who are these relevant stakeholders? You have the government, you have your shareholders, you have the owners of the business. For the government, how do you pay the government back? You pay the government through a corporate tax. You pay tax. We call it company tax. You pay a company or a corporate tax. And likewise, you are going to pay your shareholders a dividend for the money they have contributed, and you have declared a profit, so they are entitled to a dividend. So you have a dividend for the preference shareholder, who we are going to pay first, and for the ordinary shareholder, who will receive the final profit after you've given the preference shareholder. So these are some of the items that appears in your appropriation account. And likewise, in some cases, it is not all the profit that is being given to the shareholders after you have paid your corporate tax. Sometimes companies may decide to take some part of the profit and keep it for future purpose. We call such act as reserves. We call it reserves. So some companies may decide it is not all their profits they are going to give as dividend to the preference shareholder and ordinary shareholder. No, they might say among the profit, maybe 50% or 10% of that profit will be set aside as reserve. So in your appropriation account, you are going to have an item we call reserves. So after you have your net profit here on the credit side, and you have your corporate tax here on the debit side, you pay your dividend to your shareholders, to the preference shareholder, to the ordinary shareholder, and likewise the board of directors may decide to set aside some amount of money as reserve. Now the difference, let's say for example here is 100,000 naira, and probably the total of these items is 80,000 naira. We still have a difference of 20,000 naira. And that 20,000 naira is what the remaining amount we refer to it as retained profit. Retained profit. So we are going to have a retained profit here. Now in this case, it will be 20,000 naira. And by the time you add, here will give you 100,000. And likewise, the credit side here will give you 100,000. And the account has balance. So this is the final end of the trading profit and loss account. Like I said, the trading account is similar to the sole proprietorship and the partnership business. The profit and loss account is likewise similar to the sole proprietorship and partnership business. We said the only difference is on the debit side, under the expenses, you're going to have director's remuneration,
audit fees, and debenture interest. After you have arrived at your net profit, you are going to continue to appropriate the net profit. It means this final profit you have to share it to the relevant stakeholders. As a company, you are required to pay tax to the government. We call it company tax or corporate tax. Then you are going to pay dividend to your shareholders. When we say dividend, it means their return to the money they have contributed. By the time you have contributed to a business, you are contributing in order to make profit. And that profit is what we call dividend. You pay your preference shareholder first, then your ordinary shareholders. Then likewise, we said the board of directors may decide to set an amount of money out of the profit as reserves. Then you write reserves. Now the difference between the net profit and these four items, the remaining amount is what you call the retained profit, which will go to your balance sheet. And by the time you add the debit side and the credit side, the amount will be the same. Now this is the trading profit and loss account. Finally, you are required to extract a balance sheet. You are going to extract a balance sheet. Here we know we are going to have a fixed asset or the non-current asset. You have your cost, depreciation, and your net book value. And so we have land and building, plant and machineries, motor van, then you have the current assets here. This side is all similar to the final account of a sole proprietorship or the final account of a partnership business. So you have stock here, you have debtors, you have cash at bank, cash at hand, you have cash at bank, you have prepaid expenses, and other current assets. Down here you have the capital. Now, unlike sole proprietorship or partnership business, I would say capital add net profits, less drawings. No, here you are required to state what is the authorized share capital of the company. And by the time you say the authorized share capital, you close it. You tell us the issued and fully paid capital. After you've stated the issued and fully paid capital, then you also tell us we have a new heading that we call reserves. And under these reserves, we are going to have share premium. We are going to have the retained profit. We are going to have the proposed dividend. For the preference and for the ordinary shareholder. And if you have not paid your tax, you have the corporate tax. Then you're also going to have reserve, that amount you have set aside by the board of directors. Then you bring your long-term liabilities or the non-current liabilities. Maybe you have the venture. Then you bring your current liabilities. Example of current liability, we have the creditors, we have bank overdraft, and we have accrued expenses. We have bills payable. And by the time you add all these items, this side must be equal to this side. The capital and liability side should be equal to the asset side. Meaning by the time you add the net book value of your fixed asset plus your total current asset, the amount should be the same with the issue fully paid capital plus your reserves, your total reserves, plus your total long-term liability plus your total current liability. Both sides should be equal. If they are not equal, it means you have made mistake somewhere else. God's willing, in our next class, we will look at a very comprehensive illustration to show how, or to illustrate how these entries are being made from the trading profit and loss account down to the balance sheet. So this brings us to the end of today's session. So we'll meet in the next class. Thank you.